Welcome to Mark Arnold's Finance. Today I want to talk about 5 stocks to buy in February of 2023. 4 of these stocks are good for long-term plays, a few for dividends, and then I want to provide one higher risk, higher reward stock that many of you probably have not heard of. So this is going to be a great video that you want to stick through till the end. So let's start with my portfolio performance. Of course, this is something I share with every single video. That's the type of transparency I provide on this channel. So be sure to subscribe because I provide you guys with a lot, the good, the bad, and in between. Now, I am down back in the red. Last video I was in the green, but I'm slightly in the red now by 0.15%. That's about $72 of unrealized losses. And we have a lot of big earnings this week, so I bet you we see some volatility and some swings, which might be a good buying opportunity for these stocks I'm about to mention. So let's start with stock number 1, which will be Adobe. Now, Adobe, they are in the information technology sector and in the software industry. And they operate through 3 segments: digital media, digital experience, and publishing and advertising. Now, just recently with Adobe, they are going to be acquiring another company called Figma, which is a collaborative web application for interface design, as Adobe recognized that this is a strong competitor. So what did they do? They're buying them out. So you will see Figma's CEO announcing this late last year to employees. And this is why I love Adobe and companies that are of high quality, because they're making sure to stay on top and take out any competition, which makes them a strong investment over and over year after year. So if we look at its fund analysis, we will see it's considered undervalued, of extremely high quality, more towards the lower growth stability, but that's going to be all tech stocks because of high inflation, the exchange rates, all that stuff affects big global tech companies the most. And then the financial health is towards the healthy range. And we'll see here in the financials, the metrics chart that I created to provide you guys with the most important metrics that I deem to review before buying a stock. And we'll see here the PE ratio is lower over the trailing 12 months than the 5-year average. It's at a 36.7 versus the almost 55-year average. Now, its earnings per share has slowed down to 0.8%. But you will notice as you start looking at the earnings, and I bet you through this week, earnings and revenue and cash flow are starting to turn even negative. So if companies can stay above that, those are the ones to really focus on. So revenue stayed decent at 11.54%. We'll see they still had positive cash flow of 8.41%. This is not a dividend paying company, so if you want dividend stocks, this might not be the one for you, but I believe it's going to provide amazing growth. Look at this gross margin, one of the best I've ever seen. It's at 91.61%. Return on equity is great at 33.86%, and very important, the debt to assets is low at 17.51%. I can't stress this enough. During hard economic times, a possible upcoming recession, companies that are low leveraged with low debt are the ones that will survive and even thrive. So that's why I really like Adobe. We'll see here, analysts are predicting a 12-month price forecast of $380. Right now it's at $370. So that's about a 2.5% upside, which is kind of low, but I am looking at the long term, and I think Adobe is setting itself up for a great 10 to 20 years of beating the S&P 500. And you'll see here on the left, I highlighted in yellow, that's their stock price, so it's been going down over the last 6 months to a year. Now, Adobe, I know a lot of professionals in the designer industry, profession field, and they all say Adobe is their preferred product and is the industry standard to use and is vital to what they do. It has strong reoccurring revenue through subscriptions, and in a continued move towards digital content in a growing digital world, I think Adobe is offering a great buy right now for the long-term investor. So that's my first stock pick. The next one is Microsoft. Now, this is another pick in the information technology sector, in the software industry, and we all know Microsoft. It licenses and supports and develops software, services, devices, and solutions worldwide. It operates under 3 segments: productivity and business process, intelligent cloud, and more personal computing. If we look at its fundamental analysis, it is considered undervalued, which is kind of rare for Microsoft. It's considered of higher quality, very low growth stability, which I think is because we're seeing a decline in all their products and services. But there's something I'm going to mention at the end that will turn that around, I think, in the future in a big way. Its financial health is a little bit more towards the healthy end. And if we look at its metrics, we'll see here, again, its PE trailing 12 months is lower than the 5-year average. It did shrink in earnings per share trailing 12 months versus the prior, but the last 5 years has been great at that 28%. Revenue is remaining strong. Cash flows did shrink, which I told you we will be seeing, but the last 5 years has been great at 24.67%. They pay a low dividend, but they have a low payout ratio of 30%, so I think they will increase their dividend very healthily year after year. They have great gross margin, shall I say, at 75.19%, a good return on equity of 39.32%, and again, that low debt to assets, which actually shrunk more this last earnings than the prior, and now it sits at a 21.73%. I love to see that. Analysts are predicting a 12-month forecast of $273. It's now sitting at about $248. And I think even as of today, it's down more towards $240. It's providing a 10% upside, and I think it's even a bigger upside than that. But what the main thing I want to mention with Microsoft is they are going into artificial intelligence with everything they got and want to implement it into all their business. That's what CEO Nadella said. So Microsoft is in talks to increase its investment in artificial intelligence startup OpenAI by $10 billion in a move to make its Bing search engine a stronger rival to Alphabet's, who's Google. The Bing search engine holds nearly 9% of the market, while Google commands roughly 84%. So this will be an uphill battle for Microsoft, but I believe they can increase that 9% market share at least to 10, maybe even 15 in the near 5 to 10 year future. But they might blow us out of the water, you never know, and get further up than that. Now, OpenAI tools could be built into email platform Outlook and office productivity tools such as Word. And the OpenAI partnership could boost Microsoft Azure Cloud business. That's very important. That's their area of great growth, great profit margins. And they said, we expect dozens of new services from OpenAI ChatGPT leveraging Azure's robust infrastructure in a virtual cycle. These services will include true digital assistants, AI-based legal, accounting, financial services, and dozens more. This consumer AI will then be used in enterprise applications in equally surprising ways. So for me, Microsoft is a high quality company with a stronghold in corporate America, so it has that monopoly, has a stronger credit rating than the US government, and is preparing for the next phase of growth with artificial intelligence. This is another great buying option in February for the long-term investor. Up next, stock number 3, we're going to get out of the tech sector and we're going to go with Union Pacific. Now they're in the industrial sector and they're in the road and rail industry. Now Union Pacific, it provides transportation of lots of goods, from grains to plastics to forest products, and it has over 32,000 route miles connecting Pacific Coast and the Gulf Coast to the Midwest, the Eastern United States, so on and so forth. So what I like about this is it's a Class 1 railroad, and there are just 5 American-owned Class 1 freight railroad companies and 1 passenger railroad company, Amtrak. This list also includes 2 Canadian-owned Class 1 freight railroads, both that have trackage in the US. So you'll see there Union Pacific is listed as one of them, but let's look at the ones that produce the most revenue. That is going to be BNSF, but that is not publicly traded as Warren Buffett's company, Berkshire Hathaway, owns it. So the next one down is Union Pacific. So I am buying the one with the most revenue out of all these Class 1 railroads. And let's look at their fund analysis. They are considered slightly undervalued, of very high quality, their growth stability is high, and they are a little bit lower on the financial health. And that's because railroad companies have lots of expenses with keeping up the business and running it. So if we look at their metrics, we'll see their trailing 12 months PE is slightly lower than their 5-year average, so I believe that's presenting an opportunity in itself. Its earnings per share is at a decent 12.76%. The last 5 years was 14.44. Has good revenue growth over the trailing 12 months, not so much over the last 5 years. Cash flow is on the low end, but it's still positive. We'll see here it does pay a dividend of 2.57%, so decent, but it does increase it pretty healthily at 10.17%, and its payout ratio is below that 50% mark that I like to see at 46%. Now its gross margins are good at 49.27, has a great return on equity of 57.7. Now that debt to assets is a little high for me at 52.89. I like to see anything below 50%, but that's the name of the game with this industry. It takes a lot to run this, a lot of expenses, a lot of costs. Now their shares outstanding were going down, but from the last quarter to this quarter, it stayed the same. So I hope that's something that they continue to do, where they now start buying back shares again, because as investors, that helps with the earnings and it helps our stock appreciate and grow. So with that said, if we look at the 12-month forecast from analysts, they're expecting it to go to 221 per share, and right now it's at 202. And it's been going down over the last year, and we'll see here that this creates a almost 10% upside, which is great. So for me, the railroad companies that exist today are the ones that will still exist in 20, 30, 50 years from now, as it is extremely expensive to start a railroad company and build it out. So this industry is monopolistic in that regards, which I like, and I also feel America will see an infrastructure boom soon, and the railroads will play a big part in it as they can move bulk products like no other industry can. So people that say semi-trucks are competition, they are not. So sorry, Tesla, with your electric semi-trucks, you're not going to be able to compete with the railroads, and they still move volume in a way that semi-trucks could never do. So for me, this is a very strong, stable investment for long-term investors. Now, let's go straight into pick number 4, and this is going to be another industrials, road and rail company, and that's Canadian National Railway. Now, this is very similar. It provides a lot of products that it transfers from one part of Canada to another, and even goes into the United States. And like Union Pacific, who has over 32,000, this one only has 19,500 route miles, but it's still one of the largest. As we see here, as I mentioned before, the Canadian-owned Class 1 freight railroads that have trackage in the US are Canadian National Railway and Canadian Pacific Railway. But if you look at the revenue, I want to own the one that's making more revenue, and that's Canadian National Railway as shown here. Then you see Canadian Pacific below and Union Pacific up at top again. So its fundamental analysis is it's considered slightly undervalued, of high quality, very low growth stability, and less on the financial health, but more towards the middle. If we look at their metrics, they are cheaper on the trailing 12 months for the PE ratio than the last 5 years, but their EPS is slowing down. They actually have declining operating cash flow over the last 12 months at negative 7.91. Now they are a dividend play. They don't pay as much as Union Pacific, but they pay about 2%. They do have a lower payout ratio of 42%, and their gross margin is very good though at 50.17. They have decent return on equity. They have low debt to assets. Anything below 50% is good, which compared to Union Pacific, them having the lower debt, they're kind of like offering two different things in my opinion. Also, with their forecast, they're expected to go to 127.62 over the next 12 months. Right now, they're about 118, and they've kind of remained flat over the last year, but it's providing an almost 8% upside. So again, railroads are monopolistic, and I would also like to hold the largest Canadian play and carry two great railroad companies. So you probably notice I have 2 software plays and 2 industrial railway plays. I feel holding a few of the top companies in the same industry is a great play to spread out risk and be included in 2 companies that will provide strength in different areas within the industry. So with that said, I thought I would make my last pick a small company that many have not heard of with a little more risk but more potential for reward and profits, and they're called Taboola.com. TBLA is the ticker symbol. They are in the communication services sector, and they're in the interactive media and services industry. Now, Taboola.com, together with its subsidiaries, operates an artificial intelligence-based algorithmic engine platform in Israel, the United Kingdom, the United States, Germany, France, and internationally. It offers Taboola a platform that partners with websites, devices, and mobile apps to recommend editorial content and advertisements on the open web to users. Taboola.com was incorporated in 2006 and is headquartered in New York and operates as a subsidiary of Nexstar Media Group, which I think many of you have heard of, but Taboola is not very well heard of. Now, Taboola is a communication services sector AI play, which sounds like a win because the communication services sector is very undervalued currently, and artificial intelligence is the future and should provide great growth. So I see this as a potential win-win. Now, this company has big companies choose them to do business with, such as IBM, IKEA, Microsoft, Pandora, BMW, and they just entered into a 30-year deal with Yahoo. Now, their fundamental analysis, they are considered very slightly undervalued on the lower end of quality, on growth stability, and then they inch up a little bit higher in financial health. So if we look at their metrics, they are not reporting a PE ratio because they're not making a net income at this point, but their earnings per share trailing 12 months versus the prior is up a massive 91%, though the last 5 years has gone down 6.3%, but it looks like things are starting to turn around and pick up speed. Revenue's a little low, but positive, and you'll see their operating cash flows over the trailing 12 months has gone down 19.5%, and over the last 5 years, 7.88%. But I think smaller companies, sometimes they have to put those expenses up front to pay for things to help them grow in the future. And this is not a dividend play, so if that's something that's important to you, this will not be an investment for you. But their gross margins are good at 35.38. The return on equity is negative at 3.35, which I want to see this turn to the positive, so you want to look closely at that over the next couple quarters of earnings. The total debt to assets, really what I like about this small company is it has low debt at 23.18%, and that's going to help this company make it through an economic hard time or recession. I also see that their shares outstanding are going up, which I do not like to see. I like to see them going down, but usually with smaller companies or startups, they have to raise capital somehow, and that's one way to do it. So it's not necessarily a bad thing. Now, analysts over the next 12 months expect the stock to go to $4.71. It's now about $3.86, so it's providing a 22% upside potential, which is a great opportunity for us. So with Taboola.com, I feel this is a company I would like to invest a small amount in to capture a huge potential upside in a very unique, unknown company. I will only invest an amount I am comfortable with losing, as I feel there is risk with small companies because there's a lot of big competitors out there that can just bully their way in there. But I like what I see with this company and think this offers a great chance to invest in something a little different. So with that said, let me know what you thought of my 5 picks, if there are stocks that you would be buying, or what stocks will you be buying in February of 2023. I think we're going to see some volatility, some buying opportunities, so I do have some cash on the side, and I'm just waiting to see what I might be able to get into at great valuations. So give me your thoughts. I really appreciate you guys joining. Be sure to subscribe, and we'll see you next time very soon on Mark Arnold's Finance. Have a great day.